from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, add Snap to the list of big tech names laying off hundreds of workers. This is two top ad execs leave Snap for Netflix. The slowdown in revenue growth being felt across the tech industry, and some companies like Netflix are turning to ads as the answer. Plus, Mark Zuckerberg's conversation with Joe Rogan offered a glimpse into his vision for Meta. But the tough reality is that vision hasn't changed much since Facebook bought Oculus back in 2014, and people just don't seem that into it. And we continue our EdTech series after a new poll shows less than half of Americans support President Biden's student debt relief plan. We will also chat with the CEO of the textbook maker Pearson, who thinks NFTs could be a new revenue stream. All of that in a moment, but first let's get a look at the markets. U.S. stocks ending a turbulent month on a down note. Bloomberg's Katie Greifeld with us now for more. Katie, walk us through the day.
Emily, 2 straight days we've opened in the green. 2 straight days you had stocks finish in the red. That's what we saw today. You had the S&P 500 down 0.8%. Big tech also closing down, not as down, but still 0.6%. For some reason, the ARK Innovation ETF, sort of the poster child for speculation, it was the relative outperformer today, but still lower. Of course, all of this coming as we continue to digest commentary from Federal Reserve officials sounding very hawkish that lifted 2-year yields up once again. It was the Philadelphia Semiconductor Index that really led losses, though. This is becoming a trend. We've seen this over the past 4 days now. The SOX index down over 9%. Those chips just really not catching a break at all, as you can see in the chart behind me. But let's get specific and talk about some names here, because there were some really interesting corporate stories, as you talked about. Bed Bath & Beyond announcing its turnaround plan. They're going to shut 150 stores, cut 20% of their workforce, of course, trying to reduce costs. Shareholders not exactly giving a vote of confidence here. Shares closing really 21% lower, just absolutely cratering today. You contrast that with what we heard from Snap, also saying that they're going to cut 20% of their workforce, but investors clearly cheering that a little bit more. Shares up 9%. And you did see other social media stocks lift as well. Snap did reveal that revenue jumped about 8% or so in the third quarter. That helped out Meta Platforms, for example, up 3.7%, Emily.
All right, Katie, thank you for that roundup. I want to get back to Snap now. As Katie mentioned, slashing staff, scaling back on investments to rein in costs after a broader pullback on ad spending, snapping its sales growth this year. Snapchat's parent company, the latest in a wave of tech layoffs that has plunged the NASDAQ into choppy waters. Let's get the latest now with Bloomberg's Alex Barinka. So, Alex, this is a pretty deep cut we're talking about, and they're cutting a lot of businesses that were generating a lot of buzz. What's happening here?
That's right. It's a deep cut, and it doesn't just stop at headcount numbers. So Snap has its core Snapchat platform. They've also kind of rolled out a number of buzzy projects like the Pixie drone, which flies around and takes pictures, or like app mini games within the app. A lot of these projects are falling by the wayside. They're either being killed or scaled back in the case of something like Snap's Spectacles. Now, all of this has basically come to a head as the company said, the CEO said in an internal memo, that revenue growth for this quarter is basically going to hit single digits for the first time ever since they're a public company. So they are looking at the company, really refocusing on anything that is monetizable, on their ad business, and on any future potential places to make revenue, and culling basically everything else, Emily.
They're also losing their chief business officer, Jeremy Gorman, going over to Netflix. We actually recently had Jeremy right here on the show. What do you make of this?
Yeah, so this is part of this kind of restructure / reorg that Snap has all of Jeremy Gorman's businesses are shifting over to a new chief operating officer that they have promoted from their engineering team. Look, I think that an analyst over at JMP Securities summed it up best. They said, we don't really know who's in charge of the ad business right now. I think it'll be another bit of this kind of prove me process to be sure that leadership there at Snap really can show that they can kind of lean into the role that Jeremy is exiting. She is a kind of seasoned ad executive. She is really strong on the ad sales side and has experience at other big tech companies. So they definitely have a bit of a gap there to fill. And look, that whole business, which is the money-making arm of Snap, will now be reporting into a brand new exec in a new seat. So for investors, they're happy to see the cost cuts from the news today, but I would guarantee that that's going to be a place that they're watching because that is, the bread and butter of Snap's top line.
Now there's been a lot of tumult in social media, but for somewhat different reasons. Obviously, Meta, we reported yesterday, they're laying off a bunch of contractors, also doing this big pivot to the metaverse. Twitter is embroiled in this lawsuit with Elon Musk. You've got TikTok, fighting these content moderation wars, but kind of winning on the engagement side. Can you compare Snap's fortunes with these other competitive platforms?
Yeah, I think it's really interesting, Emily. Snap has really kind of benefited from its reputation and its prowess with younger generations. That is really when advertisers go there to spend money, that is one of the things that's top of mind. Snap owns the younger generations. Well, now you have TikTok on the scene, who has also really done well to win over the downloads and the business of those younger audiences. So you have TikTok kind of leaning in and pushing in on Snap and kind of threatening their core user base. And then you have places, as you mentioned, like Meta, and I would also throw Google, its search and YouTube businesses in the mix there too, which are a bit more, I would say, dependable for advertisers. So if you're looking at a where is the money going basis, we've seen for the last few earnings cycles, it's not really going to Snap. TikTok's a private company, so we will see. Meta and YouTube, Google seem to be continuing to kind of rake in the cash. So it's definitely a fight out, and I would toss Instagram there in the mix too as well, probably somewhere in the middle. It's definitely a battle that is raging that we'll be paying a lot of attention to, but when it comes to Snap, again, this kind of podium they've been on of owning Gen Z, of owning the teens and 20-somethings, I think that's really coming under threat in a way that perhaps they haven't seen before from the likes of Facebook, Instagram, or YouTube.
All right, Alex Barinka, thank you. Cover social media for us, appreciate it. Well, as we mentioned, those two Snap executives going from Snap's ad business to help Netflix launch their ad-supported platform. Jeremy Gorman, as we mentioned, along with the president of ad sales, Peter Naylor, joining Netflix in September. Here to tell us more about this, Bloomberg's Lucas Shaw. So, Lucas, how big a coup is this for Netflix?
I mean, look, they took two of the top executives in the digital ad business right now. Peter Naylor in particular, though Jeremy Gorman, I believe, is more senior at Snap. Peter Naylor helped build the ad business at Hulu, which, other than YouTube, is really the biggest digital video ad business in the U.S. Netflix has spent the past couple of months, if not longer, looking for some executives to lead the charge for them as they move into advertising, and now they have two really solid people.
So at this point, what do we know about Netflix's ad-supported tier, how it'll compare to Disney's ad-supported tier, etc.?
We know that it's going to debut either in the final 3 months of this year, likely November, December, or at the very beginning of next year. My reporting has suggested that it will cost about half as much as the basic Netflix tier, so think like $8, $9. There will be advertising in some programming, but not all, not advertising in kids programming, at least not at first, not advertising in new movies. And there'll be ads before and during some programs, but not after. And they're aiming for about 4 minutes of advertising per hour. You brought up Disney. The 4-minute Netflix, sort of like Disney and like HBO Max, is aiming for a low advertising load, and they can charge a lot for those advertisements. They don't want to have much more than 4 minutes per hour. They don't want to make it uncomfortable for the viewers. That's much easier said than done, and we'll have a better sense of what this looks and feels like when these services come out at the end of the year.
Couple interesting headlines out from Dow Jones. One, that Disney is exploring an Amazon Prime-like membership program to offer various discounts and perks. Another that Netflix is looking to charge brands premium pricing for this ad-supported tier, which is not necessarily a surprise. What do you make of these?
Yeah, I mean, the Disney news, I think makes a lot of sense. They already have a bundle for their 3 streaming services, and they also will charge fans of their parks for what's called an annual pass, where you can pay one set price and get to go again and again, with the exception of certain days. Look, Disney is the one media company that has a truly loyal fan base. They love the brand, they love the characters. And so them trying to create one bundle for their super fans that people can pay and reduce churn or the number of cancellations for some of their services makes all the sense in the world. As for Netflix, I honestly don't think that's really news. Both the Journal and we have reported before that they're looking to charge premium prices.
All right, that would make sense. Bloomberg's Lucas Shaw, thank you very much. Meantime, Twitter has subpoenaed Stanford University as part of its legal battle with Elon Musk. Yes, the university. We'll tell you why next. This is Bloomberg. Let's get the latest now on the Musk Twitter trial. The billionaire asking for more time again, this time to dissect the claims of a whistleblower. And also, Elon Musk wants to talk with his alma mater, and that is Stanford University. Here to explain, Bloomberg's Jeff Feely. So, Jeff, let me get this straight. We thought it was Twitter subpoenaing Stanford, but actually it's Musk subpoenaing Stanford. Why would Musk want information from Stanford University about the Twitter deal?
Okay, so we don't know for sure, but one of the Twitter board members, a Dr. Lee, works at Stanford and is one of the AI experts at Stanford, so it could be that. It also could be he wants to check and see who she had conversations with among her colleagues about, problems with the deal. So,
where exactly could this lead?
Well, I mean, what's going on here is both sides are trying to put together their cases for the October 17th trial. And Mr. Musk wants to know what conversations the Twitter board members have had with people about this, obviously looking for material that would help him justify walking away.
Interesting. Okay. Well, obviously this case is changing by the minute. Yesterday, we learned Elon Musk wanted to try to get the trial pushed to November. Now he's potentially trying to get it pushed even further out to December. What exactly do we know about what Musk is asking for at this point?
Well, they're asking to push the trial to late November, early December to give themselves and the Twitter folks more time to dig into the allegations of the whistleblower that have emerged. And, people need to find out whether his allegations are substantial or sour grapes. This gentleman was fired from Twitter as head of its computer security for what the company says were performance issues. So it's going to take some time to really dig into this. And they're running out of time in terms of discovery.
Late November, to state the obvious, is Thanksgiving in the United States. So that, leads me to potentially December. What's the likelihood, in your view, that this trial gets moved? And when will a judge make a decision on this?
Well, we don't know when Judge McCormick will rule, but most people believe she's going to grant more time because the emergence of this gentleman was a surprise, and there's some inkling there could be other whistleblowers coming down the pike. So there could be a need for, to push it back in the interest of justice.
So here's the question. Elon Musk, said he was going to buy Twitter with no diligence. That's on Elon Musk. Why are these additional claims actually relevant?
Well, the whistleblower raised issues about lax computer security and privacy concerns. If Twitter did not disclose those things to Mr. Musk as part of the deal, and even though he didn't do due diligence, they still have legal duties to disclose things like that. It's called representations and warranties. And if the judge finds that they should have disclosed those things and didn't, it can sink the deal.
All right. Lots going on here. Jeff, really appreciate you continuing to give us the play-by-play and help us make sense of all these moves. Bloomberg's Jeff Feely in Delaware. Very busy guy for us. Thank you. Meantime, two of the world's most influential chip companies are in the midst of their own legal battle. ARM says it's suing Qualcomm for trademark infringement. Started after Qualcomm bought Nuvia, which uses ARM licenses that can't be transferred without permission. ARM has created much of the underlying technology for mobile electronics. We'll continue to follow that story as it develops. Coming up, why not even Joe Rogan may be able to save Mark Zuckerberg's metaverse pitch. That's next. This is Bloomberg.
You won't be able to have this experience in the future where, like, you're sitting in a meeting and your wife texts you and it pops up in the corner of your glasses and you want to respond, but you don't want to like pull out your phone because that's kind of rude, right? So you just kind of like, I don't know, twitch your wrist a little bit, maybe like this, like some super discreet motion that no one even knows you're doing it, and you just like send a message. And
that seems like a massive distraction. I mean, people are already distracted by their phones. Like when people get a text message and they're like, hang on a second, I just can't answer this real quick. And you're like, okay. And you're sitting there having lunch with someone and they're not talking to you anymore because they're looking at their phone. But now they're going to be looking at these AR glasses and just thinking out text messages.
Just some of Mark Zuckerberg's very lengthy conversation on Joe Rogan's popular podcast last week. 3 hours, the interview was, an opportunity for Zuckerberg to defend Meta's pivot to virtual and augmented reality. But as you just heard with Rogan's rebuttal, Zuckerberg's vision is facing a tough reality. Here to discuss, Max Chafkin. So there's a lot here, Max, but overall, what do you make of how Mark Zuckerberg portrayed his vision and how Joe Rogan reacted to it?
Well, so the thing that was just striking to me, as somebody who's followed this for a long time, is how little Mark Zuckerberg's VR, AR, metaverse, whatever you want to call it, how little that vision has changed. We've kind of, over the last 6 months or so, been talking about it as if it's this, brand new thing. Yeah, they're spending billions of dollars. And kind of forgetting that Facebook purchased Oculus, the company that seeded the VR effort in 2014. It has spent, even before spending $10 billion in 2021, it had spent billions and billions of dollars marketing several successive devices. And, they had a Super Bowl ad in February and really has gotten not a whole lot of traction, all things considered. And I think part of the reason is what we just heard, that this pitch, which is that you're going to kind of want to put Facebook inside of virtual reality and strap it to your face is just not that compelling, and they really still haven't figured out a way to sell it. And for 3 hours with Joe Rogan, we saw Zuckerberg kind of working, basically trying to his every trick he could think of to sell it, and coming up short, I would say.
Now, I'd actually heard that texting example from Zuckerberg before about his wife sending him a text and how VR could be cool to help him check that text without other people noticing. This one was new to me. Take a listen.
There's something that's just so primal about it. That's I don't know. It's. And since then I've just introduced a bunch of my friends to it, and that's been really fun because now it's like we train together and we just like wrestle together, and just I don't know. There's like a certain intensity to it that I like.
Now I understand that maybe Zuckerberg's trying to show a little bit more of his human side, but there's a sort of naivete there, or a falling flat, I might say.
Yeah, one of the most successful tech people in the world, bringing the cringe to Joe Rogan. It maybe wasn't clear if people were just coming to it cold, but he's talking about jujitsu. Mark Zuckerberg has gotten into, combat sports, and he was trying to bond with Joe Rogan. And again, I think, kind of jokes aside, with this, it just shows like this company is trying everything they can to connect with people. So, they've tried Super Bowl ads, they've tried, demos, and now Zuckerberg's, sort of trying on this like alpha male, I'm into fighting sports thing to convince Joe Rogan's audience, which is substantial. I mean, Joe Rogan has, the most successful podcast in the world to, give the, Oculus or the Facebook VR devices a shot.
Meantime, let's talk about what he had to say about sort of screens and television and how he imagines all of these different screens and interfaces working together. Take a listen to what he had to say.
I just want the time that people spend with screens to be better. Because, I mean, today, so much of it is like you're just sitting around and, I don't know, in this like beta state, consuming stuff. And I think that's like, I don't know.
So I wonder what he means by beta state there, and if his vision of screens is actually what people want.
Yeah, it's hard to understand if you're trying to kind of connect with the masses and convince them that this new product you have is great, that you want to start out by sort of, dissing what's basically the most popular entertainment medium in the world. I think what he was trying to say is that television is passive, and he was sort of using this kind of Joe Rogan verse, alpha meaning active, strong, manly, passive meaning, so beta meaning passive or almost effeminate to refer to television. But it really is kind of a head scratcher. And I just think it just goes to show how kind of all over the place the marketing has been here. And it's worked in certain ways, right? Like these hardware devices have sold reasonably well as kind of video game consoles, but in terms of trying to broaden this out, making this something that regular people are going to use for meetings or for travel or something, I mean, really, we're not anywhere.
All right. Well, if you have 3 hours, that's Mark Zuckerberg on Joe Rogan. If you want to hear more, Bloomberg's Max Shafkin, who also wrote about it in Bloomberg Business Week. Appreciate your thoughts. Okay, coming up, why less than half of Americans approve of the president's student debt relief plan and what it means for the future of education, technology, and online learning. Plus, later, how NFTs could change the textbook industry of the future. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. We are continuing our education tech coverage as we enter the school season. President Biden's unprecedented student loan cancellations getting some mixed reactions. A new Morning Consult political survey shows only 48% of Americans support Biden's level of forgiveness. Here to discuss, Sarah Levy, CEO of the investing and financial planning platform Betterment. So, not necessarily a popular plan. Not everyone supporting this, and a lot of debate. Sarah, where do you stand?
So I think there are economists on both sides of this issue, and I think we can agree that student loans are a major problem for this country and that there's $1.7 trillion in student loan debt outstanding, and also that this generation is more saddled with student loan debt than any of the generations that have come before. I think where the conversation gets trickier is what to do about it. And so I'm a believer personally that what to do about it lies in advice and technology, and that the federal government can play a part, but that business also needs to play a part.
How so?
Well, I think the first thing that is very true is that, folks are not good at saving and are not necessarily good at understanding, if I have another disposable dollar, where should I put it, right? And so I think there's sort of a regulatory and technology conversion here that's pretty exciting, where we now can develop tools, and we at Betterment are developing tools to really say to a student loan holder, look, what should you do with your next dollar? Instead of going to Starbucks this week, what would $5 a day do in terms of visually? We can show you visually, what would it do in terms of your debt pay down, both your timeline, your costs, and how can we set you up for a better future? And so I think that's one thing we can do is offer technological solutions. And the other thing we can do is partner with employers, right? Because as with many other great issues of the day, like retirement savings, employers have a role to play in supporting their employees.
How do you see businesses and employers playing a bigger role here? And how could that also impact the choices that students or prospective students make about how to access education?
Yeah, so I think it's a great question. I mean, I think this is, for those who aren't that excited about the current approach I think the government is taking, one of the concerns is this moral hazard issue of, are people going to make choices about their education that they're then going to expect to be forgiven by the government? And therefore, will they make choices that maybe aren't the best choices for them? And then similarly, will the costs go up because the schools know that they can access this incremental funding? So I think this is a real challenge that I think we're poised to help with in a couple ways. I mean, number one, there's more legislation, if you can imagine, coming down the pike in the Secure Act 2.0, sort of on the table later this year, that's talking about tax incentives for businesses to help potentially even with a match where you link a 401k and student loan management. So imagine if I'm an employee and I can't access my company match for retirement because I'm paying down debt from my student loan and I just don't have an incremental dollar to save. Well, here's an opportunity for the government to step in and say, okay, whether you save by paying down your debt or whether you save by putting a dollar in your 401k, either way, your employer can match that contribution. And that's a really powerful way for employers to be able to channel dollars where they're going to best serve their employees.
What would be your message to, rising freshmen right now who are considering a college education, who have, innumerable online learning options now available to them, and companies that are reducing degree requirements? So, you've got some people out there who are saying, I don't need a 4-year degree.
I think it's true that there's no one size fits all. I mean, I think on average and over time, education has helped to lead to better outcomes, for society. So, but I think we could talk about whether that education is about starting young and preschool and getting out of the gate stronger, or whether it's about a 4-year college. I think the idea that, there are vocational programs and other ways to go about it are true, but all of these things have costs and each has a different ROI. So I think, regardless of the path an individual chooses, because there are many paths, and I agree they're kind of more varied than they were perhaps, a generation ago, there still is going to be this problem of people need to borrow to fund any of these, whether it's vocational school or whether it's a 4-year college. They're borrowing. Sometimes they're not finishing their degree. They're borrowing for that. And these are costs that then they need to understand how to tackle, right? And that's really the problem we're seeking to solve is, how do we help employees who have taken on this debt? How do we help them tackle this debt in the most responsible way to give them the best personal long-term outcome?
What would you like to see next from Washington?
I think that, incentives for companies that look like the incentives for 401ks and other retirement savings would be a great place to start.
All right. Sarah Levy, CEO of Betterment, thanks for weighing in on what has been a raucous debate. Appreciate it. Okay, coming up, could the future of textbooks be NFTs? We're going to ask Pearson CEO Andy Bird about that and more next. This is Bloomberg. we're focusing on education technology and how innovation in this field is fueling a new way of teaching and learning. And in today's Crypto Report, we're talking about how NFTs could change the game when it comes to textbooks. Let's take a deeper dive into all of that with Andy Bird, CEO of Pearson, one of the world's largest textbook publishers. So Andy, I remember buying a lot of very heavy, very expensive textbooks. Can you explain to me how NFTs could change this industry?
Oh, hi, Emily, and thanks very much for having me on your show. I remember those days as well of the heavy textbook, and at Pearson, we're very much leaning into digital technology as a way forward. And in fact, now if you subscribe to Pearson Plus, you'll be able to get those textbooks for just $9.99 a month. And it's one example of how we as a company are really looking at technology to move the whole industry and the whole sector forward. I think the pandemic acted as an accelerator in terms of really transforming the world of education and the world of learning, per your earlier discussion with Sarah. And in that regard, I've been really interested in how technology and how Pearson can utilize technology, both in terms of NFTs, non-fungible tokens, and blockchain. That the notion of having a transparent ledger and the impact that would have on authors and royalties, for example, I think is very, very interesting. It also allows us to deconstruct the textbook. And, once the textbook is in digital form, you can look at ways as offering not just text by the chapter, say, but also video. You see some of the examples on the screen now of Pearson Plus. A lot of video, a lot of animation, a lot of graphics, a lot of audio suddenly starts to come into play as you look at the way that learning and textbooks are evolving. And so as a company, I think it's very important that we're sort of trying to lead research and development in that space. And that's what we're doing.
So give an example of how a textbook could be an NFT and how that could survive, be passed on to multiple students, and how Pearson could still potentially profit from it, even if we're talking, 3 or 4 students down the line, like a used textbook.
Yeah, I think of a textbook, a modern digital textbook, comprising of various learning modules. So where in the past, in the analog world, you had chapters and illustrations and pictures, in the future, those chapters are broken down, as I said, into different learning modules. And the creator of those learning modules could, in theory, mint that learning module as an NFT, and therefore not only get paid by Pearson, if that's an author. There's a real interesting angle in terms of user-generated content and all of this, by the way. But the author or the creator of that content, it could be a video, it could be take a form of audio, would then be able to participate as that learning module is utilized down the blockchain, as it were, and the blockchain acts as that transparent ledger and makes sure that everyone gets paid an appropriate amount of money. It actually, I think, could lead to greater accessibility and affordability for education as you look more globally.
Now, call me old-fashioned, but as much as I didn't like carrying those textbooks around, I still like a paper textbook. I like reading a physical newspaper, a physical book. I like underlining it, folding down the pages. Is there a place for that in this future?
Absolutely, absolutely. And we still give you the option to get that printed textbook, and we'll continue to invest behind those. As an analogy, I like the music industry, recorded music industry. And if you think of the textbook as being the vinyl record, and then the e-text as being the CD. And then in music, of course, you had MP3 players, and now you have the likes of Spotify and Tidal and others, where you pay a subscription for access to 40 million songs. In the world of education, up until recently, we've kind of been stuck in the CD. And I think the great opportunity is, you can still buy the vinyl record, you can still buy your textbook, but the great opportunity is how we utilize technology. We mentioned blockchain. I think augmented reality, virtual reality is going to play a very important and significant part in parts of education going forward. And so what really excites me to be leading Pearson at this moment in time is all of these great opportunities to really harness, the great technological innovations that have happened in other sectors like music, like entertainment, the introduction of 5G, having the ability to store everything on the cloud, the way that devices are developing, both in terms of mobile phones and the like, and bringing all of those together to make learning more accessible and more affordable to more people. Because through learning and learning throughout your lifetime, of course, we all improve ourselves and our economic outlook of society.
How are you thinking about the metaverse and how that could potentially impact the textbook industry? Obviously, it's early days.
Well, a couple of examples. I'm in Los Angeles, you're in San Francisco, and we could both be in the same classroom together in the metaverse. And we can participate in experiments, and we could go up to the whiteboard and annotate each other's notes. We could both, at the sort of click of a button, be transported back to ancient Greece and be in a Greek theater watching a Greek play, or immediately then transported into the deep, Amazon jungle, or inside a cell structure. Or if you're a medical student, look at procedures and be able to practice surgical procedures without having to use, real bodies, as it were. So many, many applications. Again, I think, for an urban, in K through 12, the ability to open the eyes and open the world to those students who previously have never had the opportunity to go and visit some of these places in the world and to have some of those experiences. I think the metaverse is a really, really interesting use of technology to enable that.
Fascinating. How much has changed since I went to school and how much could continue to change? Andy Bird, CEO of Pearson, appreciate you sharing that vision with us.
My pleasure.
All right, coming up, fears of a recession accumulating, but the CEO of Pilot says fear not. He'll tell us why next. This is Bloomberg. As some analysts are raising the alarm about the downturn worsening, one company says that despite all the talk of layoffs and fears of a recession, they have found evidence to the contrary. Wasim Daher is the founder and CEO of Pilot, an accounting firm for startups and small businesses that specializes in CFO services, bookkeeping, tax prep. He joins me now here in the studio with more on their data. So there's a lot of gloom and doom out there. We've had guests on the show who said there's going to be millions of layoffs in tech. We just saw Snap announce a 20% cut across the board. What are you seeing that tells you it's not so gloomy?
That's a great question. And, we sort of saw the same stuff in the market, all the VC memos, all the headlines. We said, let's take a look at the data. And so for us, we're the largest startup accountant in the United States. We have thousands of customers. We've processed $100 billion of accounting transactions last year. We said, what does the data show? And what we did is we took a look at about 1,000 of our customers, and two kind of key data points emerged. The first was that in June, we found that 86% of them actually maintained or even increased headcount. And then from a revenue growth perspective, Q1 definitely was a bit soft for folks, but we saw Q2's revenue growth to be actually very comparable to late 2021. So indicators are actually looking pretty good for this kind of early mid-stage startup segment.
Okay, so what's the discrepancy in the numbers?
That's a great question. And I think here's what's going on, which is, especially in the early and mid-stage, I think two things are happening. The first is that there's definitely pain from the downturn, but I think it's more specifically and more pronouncedly felt by companies that really have nice-to-have offerings as opposed to really need-to-have offerings. And the second is, I think the dynamics in kind of the late stage and public markets are very different than what you see in the earlier kind of mid-stage ecosystem for startups.
Okay. Well, let's take Snap as an example, 20% cuts. We also reported that Meta is cutting off hundreds of contractors. Alphabet's in the middle of a hiring freeze. Apple, I talked to Tim Cook, they're going to pull back on some hiring and spending plans going into next year. He said they're being very deliberate about their spending. Wouldn't it be an even more difficult world for startups that are relying on, whatever they have in the bank to survive, and many of which aren't profitable?
Yeah, so you definitely think so, but I think the thing that's interesting is, let's say you're a startup, you're targeting a $60 billion market, and because of the downturn, maybe it's now only a $40 billion market. But you're concerned about getting from 0.05% adoption to 0.1% adoption. You're not running into the ceiling. Whereas, these public companies absolutely are. When there is a 20 or 30% reduction, they're going to feel that in the financials.
Your business is interesting, and I wonder what sort of trends you're seeing in your own business in the downturn. Are more companies turning to outsourcing with services like yours rather than having these systems internally because they're trying to limit their own internal headcount?
Absolutely. I think there are kind of two phenomena we're observing. One is folks that might have built the function in-house are more interested in the flexibility of relying on an external provider. And the second is I think the tone has changed among startups, where in 2021, it was really the era of growth at all costs. Now it's, look, you need to know your metrics, you need to know the KPIs, you have to be really sharp on the numbers. And lots of folks come to us to just get a better handle on those stats.
How are you handling the downturn internally? How are you making decisions? Do we maintain headcount? Do we continue to hire? Do we make cuts?
So one of the things we feel really strongly about is the amount of money you spend cannot be a function of how much you have in your bank account. You sort of have to earn the right to spend it. There's this concept called the burn multiple, which is the amount of new recurring revenue you add in a given period and its relation to your burn rate, that those need to stay in lockstep. So for us, we think about how those ratios look, and then we also try to pre-compute a little bit. Look, if revenue trends in way X, this is what we'll do. If revenue trends in way Y, this is what we'll do, so that we don't have to be surprised as the situation changes.
Some of your investors, Sequoia, Bezos Expeditions, what are they telling you? You gotten any advice from Jeff Bezos?
Jeff Bezos, has not given me a call. I'm still waiting for the call and text from Jeff. It's been interesting because I think the dynamics are highly variable depending on what the company is up to. One of the things that we like at Pilot is you have to do your accounting. Even in tough economic times, you're not going to just not do your tax return. So we're hoping, or we feel, that our business is more recession-proof or downturn-proof than the average.
Does a more hawkish Fed change things for you and your own business?
It's interesting because I think the public market dynamics, we're many, many years away from being a public company. And I think for the companies we serve, we're really interested
in the private markets, there are down rounds, there are layoffs, there is belt tightening, there are companies making hard decisions about their priorities.
I think it's absolutely true. And I think you sort of need to kind of keep that hawkish eye on what's happening in your bank account, your current runway, now more than ever, because, as you said, access to capital is definitely comparatively limited.
So as you look ahead over the next year, what are some of the questions you're going to be asking the companies that you're working with to give you clues about how the market is changing? Like maybe this is what the data says now, but maybe there's a delay.
Sure. Yeah, I think we look at a couple things. One is our CFO services team works very closely with a bunch of our customers to help them build out their own financial models, their own forecasts, their own budget. I think we'll also see really good data about what happens in fundraising markets. There's a lot of kind of pent-up dry powder at VC firms that is not currently being deployed. I think depending on sort of when that starts to get released into the market, I think we will see potentially very different results.
Have you had any, are you in the middle of fundraising, or have you had conversations with investors that have led you to think one way or another about which way the wind is blowing?
We fortunately raised a big round in 2021, and so we have a very healthy nest egg. We're not out there looking for funding, but I think it's going to be highly variable. It's hard to say.
And earning the right to spend it.
Absolutely.
Interesting advice. Okay, Wasim Daher, CEO and founder of Pilot, thank you for joining us, and good to see you here in person.
Thank you for having me.
All right, that does it for this edition of Bloomberg Technology. Coming up Thursday, we've got CrowdStrike CEO George Kurtz. He'll join us to talk about the state of cybersecurity, whether that is recession-proof. And don't forget to check out our podcast wherever you get your podcasts. I'm Emily Chang in San Francisco. This is Bloomberg.